We are privileged to have a distinguished panel representing policy, economic, economics, capital markets, institutional investing, and real economy execution. I welcome Dr. Sunder Ram Korivi. He is founding Dean of National Institute of Securities Markets, that is NISM, and also former SEBI SSIR chair professor. And the theme that he's going to be talking about is policy, regulation, and market structure. So, Dr. Corby, we would like to begin with a structural policy and regulatory lens, which is foundational for investor confidence. So, the key areas, key focus areas are for your analysis is to structural policy signals from Union Budget 2026, fiscal discipline, institutional credibility, and investor confidence. Third is regulatory alignment which, with capital market growth. So, I have three questions for you. What are the most important structural policy signals in Budget 2026? And how does fiscal discipline influence market confidence and capital flows? Third question is, are there regulatory or institutional changes investors should track over the next 12 to 24 months? Yes, sir.
Thank you, Mr. Aryan Rana, for inviting me and for your questions. And as rightly introduced by you, we are not looking at this budget from a transactional point of view, which is stock market or tax related. We are looking at it from a structural point of view, so that we align our business and our activities better. So the answer to your first question is that when this budget was in the making, the mold was already cast. On the one hand, you have the Niti Aayog, which is the think tank of the government, and the 10-year vision flows from the Niti Aayog. And this is taken up as an input by the finance minister, and it is probably converted into 10 one-year budgets. So slices of the Niti Aayog, which is the grand vision, the blueprint for the economy, will be seen in the budget. So to that extent, the budget is fairly predictable, not just this year, but every year. That means the main sculpture comes from there. So there was an interesting article by Mr. Amitabh Kant, former chairperson of the Niti Aayog, and he said that five reforms are necessary for taking India ahead towards Viksit Bharat. The one is reforming the municipalities and making cities the engines of growth, because by 2050, about 50% of the population will be urban, and the global average is 75%. And then later on, we will be moving towards 75% urban. Okay, so urban reforms are much necessary, and they become the engines of growth. Right now, they are the third tier of the government. You have central government, state government, and municipal. So municipal infrastructure financing, and making cities the engines of growth is one aspect. The second aspect is to continue our quest towards developing depth in manufacturing. The third aspect is to help Indian companies to reduce their cost of capital. Our cost of capital is 400 basis points more than what it is for the other economies. Next one is education and innovation. And last is reduce trade barriers. So you saw a lot of focus this time on the customs. Okay, you generally have income tax, GST, and the third angle is customs. So this time the angle was on customs. So we have come on the back of about 8 foreign trade agreements, free trade agreements, and we had the big one yesterday, which is after the budget. So for the first time after several decades, when India became insular and inward looking, if you remember the way our Companies Act is written, the way our economic legislations were written, it was written with the template of the socialistic pattern of society. And entrepreneurship and industry was shunned. If all of old timers remember, in 1969, we had nationalization of banks and we had the MRTP. And all those, in that era, entrepreneurship took a back seat. And then in the 1990s, we leapfrogged into information technology and a service oriented sector. So manufacturing was given the go by. That is now being put back in the rails. So that is the answer to your first question, that the 5 points issued raised by the Niti Aayog chairperson: municipal reforms, manufacturing depth, reducing cost of capital, education and innovation, and reducing trade barriers. I think apart from reduction of cost of capital, the other four boxes have been ticked in this budget. So that's what I mean, that the mold is cast. The other aspect which I would like to highlight is that the position of the state governments, the fiscal deficits of the state governments is running out of hand. It is running out of control. And if you look at the total fiscal deficit of the center, including the states, it is not a happy picture. Now, linking this up to the second question is the fact that negotiations have been on between the finance ministry and various agencies such as World Bank, IMF, Asian Development Bank, and other multilateral agencies. Talks are also going on with the sovereign rating agencies such as Moody's, Standard and Poor, and Fitch. Okay, we have to demonstrate discipline, and we have demonstrated it, and we will continue to demonstrate it, which goes by the fact that the fiscal deficit has been estimated at 4.3%. We achieved 4.4% in the current year. And the ratio which is currently in vogue is debt to GDP, which we have maintained at 56%. It is likely to go down to 55%, and the glide path is to reduce it to 50% by 2030. So we have to demonstrate that we are maintaining the fiscal discipline. Okay. And therefore, this was another aspect where the mold was cast. Okay. So Niti Aayog gave the grand vision with 5 pillars, and the mold was cast. So if the government is negotiating with Moody's and Standard and Poor for a rating upgrade, that you would not like to upset the apple cart by going for fiscal indiscipline in this year. So this is how the fiscal discipline has been maintained. And although the gross borrowing is likely to be 17 lakh crore, if the quality of the expenditure is productive, it will be 17 lakh crore, but it will be a lower percentage of the GDP because the GDP is set to rise. We've got an endorsement of our GDP growth figures from IMF and World Bank as well as the sovereign rating agencies. And last but not the least, as far as regulatory reforms are concerned, two major financial sector regulators are SEBI and RBI. On the SEBI side, we have got a FSLRC, Financial Sector Legislative Reforms Commission, headed by B.N. Sri Krishna, which submitted its report in 2013. Elements of those have already been incorporated into actuality, with the Forward Markets Commission merging into SEBI, and you have a Companies Act 2013, which replaced the archaic 1956 Companies Act. We also have an Insolvency and Bankruptcy Code of 2016. So therefore, what is left? You have an SCRA of 19 Securities Contract Regulation Act of 1956 vintage. You have the SEBI Act of 1992, and you have the Depositories Act of 1996. So these three were remaining to be reformed, and therefore that has been taken up in the Securities Market Code Bill, which 2025, which is likely to be passed in this parliamentary session, this budget session. The Securities Markets Code will be to modernize the code and harmonize it with the Companies Act and the IBC and new capital market practices. One of the important points which not many people are talking about is the consolidation and banking. See, we all know about banking from the days of Shakespeare's Merchant of Venice. Okay, probably the oldest bank in the world was an Italian bank called Bank of Siena. Okay, fractional reserve banking took off in Sweden later on, and a lot of banking which we follow today, 1934 Banking Regulation Act, it's a British 1934 RBI Act, it's a British era act. 1949 we have the Banking Regulation Act. Okay, time to overhaul it with modern practices Banking is changing a lot. Very short time to discuss everything. So the government has appointed a committee to revamp banking consolidation. Okay, today you have several types of banks. The definition of money itself has undergone change. Okay, plastic money, electronic money, central bank, digital currency, and whatnot. We've already seen deposits being depleted. Okay, and bankers have to change their act. So it's a good thing that on a consolidated basis, a banking committee, high-level committee has been appointed. Okay, and along with the change in the times, we are also seeing that to support banking, there are other specialist institutions being incorporated in the last few budgets. For example, you have India Infrastructure Finance Corporation, then you have NABFID, National Bank for Infrastructure Development. We have a Sagarmala Finance Corporation to take care of maritime sea ocean development. So these are the new institutions. And last but not the least, I would like to say about the reforms for MSME also. A number of schemes for MSMEs financing and market development have taken place over a period of time. These schemes are being revamped and consolidated. Last but not the least, if you ask me one opportunity missed, the opportunity would be missed is streamlining the taxes in terms of tax deduction at source. Now, in capital market transactions, every basis point is important. So, if you have tax deduction at source in the bond market, it sort of muddies the waters insofar as the yields are concerned. In equities, there is a margin for profit, but in bonds, prices move in a narrow band. If you have tax deduction at source, this is one area where India's inclusion in the global bond indices has been held back because no other jurisdiction has tax deduction at source. I think you don't need it now in these days when the audit trail is so good. And you also have the cess. I thought cess is a mess, but I thought right now there are fiscal compulsions for the government to retain the cess. Okay, so once the cess goes and you have a sleeker tax regime, bereft of TDS, then we'll be moving like a well-oiled machine. Then the difference between the intention of policy and the execution and outcome of policy will be much better. I stop here and I will take further questions as the discussion takes place. Thank you.